Hi all, this is Akshara Menon from PMS Bazaar. Along with me, we have Mr. Rushabh Sheth from Karma Capital. Hi, Mr. Rushabh.
Hi, Akshara.
Hi. So before moving on to the presentation, I want to give a brief about you. Rushabh Sheth is the co-founder, director, and co-CIO at Karma Capital with almost 3 decades of experience in investment banking industry. In his engagements prior to Karma Capital, Rushabh was CIO Equities at Kotak Mutual Fund and portfolio manager, investment analyst, etc. with ASK Raymond James. At Kotak, he established excellent track records for 2 of the funds that he managed. And they were the top performers with their respective categories in 2003 and 2005. Assets of the fund grew eightfold. Rushabh was a part of the core team involved with setting up investment management business for ASK Raymond James. Rushabh holds a graduate degree in commerce from University of Mumbai at Sinam College of Commerce and Economics, and is a qualified cost accountant. Before we could start the presentation, I would request the participants to put their questions on Q&A and not the chat box. Also, to avoid stock-specific questions. Thank you all, and over to you, Mr. Rushabh.
Thank you so much, Akshara, for the kind introduction. Thanks, PMS Bazaar, for the opportunity to speak with all of you this evening. And thanks for joining the webinar. What I will try and do over the next half an hour or so is to kind of introduce Karma Capital and also take you through our philosophy, how we think about it, what we have been doing for the last 16, 17 years that we have been in existence. So what I have a presentation to share with you. I will kind of take you through the presentation, and then I will, at the end of it, have time. We will have enough time for Q&A. So about half an hour for the presentation. So thanks everybody for this. We started Karma. It's been a long journey. In 2005, we got our license in 2006. Nikhil Desai and I started Karma. We are the 2 co-founders. Pramod, can you put the next slide, please? No, the first slide, please, Pramod. Yeah. We are today managing 500 million of assets. Majority of our assets are offshore institutional money. That's the reason why a lot of you would have not heard about it, because heard about us, is because we have been much more focused on the offshore markets. It's only in the last few years that we are starting to build our domestic business. Karma has a 17-year track record. As Akshara mentioned, before that we were managing money at Kotak and before that at ASK. Today we offer portfolio management services, and we have launched our first AIF last year. And we are dedicated public equity long-only managers. From an investment style perspective, we are growth at reasonable prices. Today we are a 24-people team. And over the last 16 years, we have created almost 2% alpha on an annualized basis for the 16 odd years that we have been managing money. So that's in short about Karma. Just to introduce the team, Pramod, next slide, please. Nikhil and I started Karma in 2005. Both of us were together at ASK for about a decade, where we were part of the team that set up the asset management business for ASK. As it is known now. At that time, it was known as ASK Raymond James. Of course, Rajneesh has joined us recently last year. He is the CEO. Rajneesh has over 28 years of experience. He was with Invesco in his last stint. And he joins us to kind of head Karma, and hopefully as we get into the next phase. Next slide, please. A quick introduction on the research team. Today, we are a 8-people research team, including Nikhil and myself. We are both hands-on managers. The 8-people team that you see has a very interesting mix of people. A lot of them, almost 5 of them, have more than a decade, 14 to 15 years of experience. Tusha is a new person who joined us about a couple of years back now. And the team has also been together. So 4 of these guys have been with us for now almost 8 years. So not only is the team highly experienced, but also we have worked together for a long time. Next slide, please. This is our business development team. My colleagues are also on the call. Yogesh and Pramod are co-heads of business development. Prashant heads North Zone for us, and Tanya helps us with portfolio analytics. So this is the team. This is the core team at Karma. I just wanted to kind of quickly introduce the team so that you know the depth and the quality of team which is backing Karma today. Next slide, please. Just to take you through the investment philosophy, and I think this is very important from our perspective, the fact that we have been managing money for 17 years, we've done it on a very strong thesis of our investment philosophy. We have been practicing this for the last 17 years. There has been no change. Of course, over time, we have evolved. The philosophy has evolved, but the basic building blocks, the pillars of our philosophy, which is growth at reasonable price, continues to remain in place. We run a concentrated portfolio, about 20 to 25 stocks in our core strategy, which is basically an all cap or a flexi cap strategy, as you would call it. We also have an EIF for small and mid cap, which we launched last year. So there are now multiple products available with Karma, but with the same underlying investment philosophy. It's very important that we think independently, and patience and discipline is key to our long-term investing. Next slide, please, Pramod. So just to kind of quickly take you through our process, and this is very important and sacrosanct to us. We spend a lot of time as a team focusing on the process and ensuring that we have a robust process, because at the end of the day, that's all we control. We don't control the outcome, and therefore the process that we go through as an investment team for every investment that comes into our portfolios is very, very critical. So if you look at the listed universe of about 2,000 odd names, if you put a basic ESG screen, a minimum liquidity and size criteria, it kind of falls down to about 500 companies which are interesting. And many of these companies, when we track over a long period of time, and we kind of judge them based on sustainability, quality of management, scalability of business, etc. It boils down to a 300 odd names in our universe. So today, the team of 8 people tracks about 340 stocks closely, and that's really very critical for us, because most of these companies we would have tracked for a long time, and that kind of gives us the comfort of investing in these companies. And eventually, 100 of these are where we think there is interesting things happening. Companies which are getting into a growth cycle, companies who are leaders in the industry, and these companies which we track, the team tracks far more closely. We have models on all these companies. We do our own models, though a lot of sell-side guys service us. A lot of our research is done in-house. We have very kick the tires approach to research. So we go out, meet companies, competitors, people in the industry, and that's really part of the process. And eventually boiling down to 25 names in the portfolio, or 25 odd names in the portfolio, which is very rigorous. So if you think about it, our churn is low. Our average holding periods are 5 years plus, and that's very important part of what we do is long-term holding of companies that we own. And therefore, the churn is low, we add 3 or 4 new names a year at best, and therefore a lot of effort goes into selecting these names. Next slide, please. So how does our universe look? And this fits into what we said about the all cap strategy. And if you look at our universe today, it has a mix of small, mid, and large cap companies across sectors, and that kind of is very important because India offers a very unique breadth and depth of opportunities. And we try and capture that in when we look at our universe and track these companies closely over a period of time. Next slide, please. So this is a very important slide. I'm sorry, it's a little bit of a busy slide, but it's very critical to what we do. We've kind of crammed in maybe 200 pages of what we think is our process into a single slide. And this is very critical. The reason why I say this is because it's an intensive effort which goes into selecting each companies. And because we are early cycle in many companies that we buy, therefore we do a lot of our groundwork, primary work on our own. The team meets every alternate day to discuss ideas, present ideas. And each of these is tracked very closely. Feedback is given to the team members. They go back, circle back after finding out more details or clarifying things with the companies, or kind of collating more information. And what this does is it helps cross-pollination of ideas. So each of the analysts also gets to know what's happening in other industries, what other analysts are tracking. The way we build our teams is that there is a primary analyst and there is a secondary analyst in large sectors. And that's really very critical to what we do. And at the end of the day, the portfolio manager and the analyst have to agree for the stock to be included in the portfolio. What we look for growth, size of opportunity, market leadership in the company. We look for companies which have high entry barrier to their businesses. And maybe where we are slightly different from a lot of our peers is the fact that we look at rate of change very closely. Rather than an absolute number on capital efficiency, which is ROC or ROE, what we look for is the rate of change. We need companies who have high rate of change. So they can start from a slightly lower ROEs or ROCs, but they should end up with significantly higher ROCs and ROEs in the next 2 to 3 years. So that's really kind of benchmark we look at, and maybe that's where we are slightly different. Efficiency of capital allocation is very critical to long-term success of a business, and that's what we kind of measure very closely as a team, eventually boiling down to what we think are the high conviction ideas. So if you look at our portfolio, it boils down to 20-25 names across market caps. More importantly, for the top 10 ideas, we have a reasonably large weightage. So typically the top 10 would comprise more than 60% of our portfolio. And that happens over a period of time. And I will come to portfolio construction in a minute. But that's how the process works from our end in terms of the whole team, how it comes together, how the ideas are researched, tracked, and then eventually got into the portfolio. Next slide, please. So how the portfolio construction process works for us. We have, as I mentioned, 20 to 25 names. We believe, and we size our positions. So each of these positions would start small. On an average, we start with about 1.5% position, and then we scale it up over time. Generally, we feel that over the next 3, 4, 6 quarters, sometimes that we scale up the position to the maximum size based on size of liquidity and the overall size of the business. Also, our understanding of the risk associated with each of the businesses. So from our perspective, portfolio construction is very critical and important part of what we do, apart from our research and apart from our stock picking. And over time, we've seen that managing risk through portfolio construction is extremely important. We are benchmark agnostic and market cap agnostic in our flagship strategy. Next slide, please. So, we say that we are early cycle investors, and we believe that everything goes through a cycle. And I'm kind of going to take a little bit of time to explain this in terms of how we do this and what we do. Next slide, please. So we believe, and I have this very interesting quote from Taylor Swift. People quote a lot of investment professionals. Well, we kind of quoted Taylor Swift here. That it's exhausting to root for an anti-hero. And the reason why we say this is because when we are early cycle investors in many of these companies, the past of these companies for some reason or the other might not look very exciting, but we think that the companies are entering a very interesting phase or growth phase of their cycle. And every cycle, every business, like human beings, goes through cycle. Generally, our endeavor is to buy these companies, and we've always seen that the stock price bottoms out much after the business bottoms out and starts picking up. So as we mentioned, we think that once the business has bottomed out, And before the price bottoms out, we kind of generally start to buy, and therefore we say we are early cycle. So many a times the past doesn't look that good, but we're buying because we think that the future is very exciting, and we are early in its growth cycle, and that's when we get these businesses at a reasonable price. So when we talk about GAP in an Indian context, where we are also looking for growth, to find the growth at reasonable prices, this is very important, a part of what we do. Next slide, please. So just to give you some examples of companies that we today own in our portfolios, we bought Bharti in last quarter of 2020 calendar year. If you were looking back at Bharti in December 2020, the last 3-4 years would have looked very unexciting because of the large competitor coming in and crashing the prices on the Indian mobile side. But we thought that worst was through, and they had already taken the first price hike. The stock was available at a very reasonable price if you looked at it from an EV/EBITDA basis. And more importantly for us, the worst was behind in terms of the cycle, and we think very exciting consolidation in the market was going to lead to a very long growth cycle for this business. So, just an example of how and why we bought Bharti. Next slide, please. I'll give you another example of a business we bought, and we didn't know COVID was coming just before COVID. Again, Cipla, if you look back in March of 2020, February of 2020, when we started buying for investors, looked unexciting because it was coming out of a difficult cycle. Of course, once COVID came, it kind of accelerated the whole perception about pharma. But we think that Cipla anyway was coming out of a very long cycle in terms of poor capital allocation and therefore impact on margins and business. And now getting into a cycle where we think that the growth opportunity in the domestic side, which is what is the most exciting for us, and their South Africa business also behaves very similar to their India business, but for the currency fluctuations. And we think that pharma, and I will come to that later, is at a very exciting stage of consolidation in the industry, and Cipla being one of the top companies in the industry will be leaders to consolidate the industry. Again, and as an example of early cycle and how we think when we buy in terms of the companies are entering a growth cycle. Next slide, please. And this is an old example. We bought State Bank when it was below $200 in 18-19 year, when it was going through a very difficult phase, both in terms of the business as well as in terms of the NPA cycle, and available at half the book value. And nobody was wanting to look at it. Today, as you all know, last week they declared the results highest ever profitability for any Indian company in a quarter, not just a bank, but any Indian company, which is the kind of transformation which has happened in the last 4 years in State Bank. So again, when we bought it in FY 18-19, if you would have looked back, it would not have looked great. But of course, a very exciting cycle kind of awaited at that time, State Bank. So just some examples of how and what we do in terms of early cycle. And it's very critical because, when we buy into a new name, sometimes people ask us, oh, but, this name has not done well for the last 3-4 years. And we try and explain that you buy a business for the future, not for the past. And this is very important. Most of the time we see people investing with a rear view mirror, looking at the past and saying that, oh, this past will continue forever, or extrapolating that past, and which is quite dangerous to us. That's why we said everything goes through cycles. So it's not, you have to be very careful where you are in the cycle when you buy a company just based on past. Next slide, please. How our portfolios are different, and this is exactly how our portfolios are different and maybe complementary to a lot of other portfolios that you see. Today, healthcare is our largest holding, followed by telecom, which is basically communication services, followed by media. Again, very interesting sectors. And then, of course, the bottom-up ideas across various other sectors. So we are completely bottom-up investors, agnostic to the market cap and agnostic to the index. That's why our active share is reasonably high at more than 95% most of the time. And that's primarily because we kind of find best ideas across sectors, irrespective of how far away we are from the index. And that also, in many ways, to investors provides a complementary portfolio, because otherwise, you end up with portfolios which are maybe have the same kind of exposure across sectors. So this is how we are different as compared to the index. And maybe I will take you in a little bit of detail in terms of why and what we think about these sectors. Next slide, please, Shimo. It's a busy slide, but just kind of wanted to put our portfolio stats in terms of what we think, in terms of what is happening to our top 10 holdings, also our overall portfolio, in terms of growth rates, in terms of debt to EBITDA, in terms of return on equity. And if you can see, the rate of change, as I mentioned, is very critical to us. So you can see that a lot of our companies are going through significant acceleration of rate of change on return on capital employed. And the valuation on these companies still is reasonable as compared to the market. That's very important for us from where we stand. Again, composition of our portfolio today, about 25% on large cap, and then equally split between small and mid cap for the rest of it, for the rest of the 75%. And then, of course, there are more quantitative details there, which I will not bore you with. You can always get our presentation to have the details. Next slide, please. So if you look at our returns, as I mentioned, we've kind of generated 2% alpha on an annualized basis for the last 16 odd years. If you look at our performance across any rolling criteria, performance benchmark criteria, we've kind of beaten the index, whether you take 1 year, 3 year, 5 year, or 10 year rolling. Again, I'm not going to bore you with this. All these information is available very easily on our website. Next slide, please. So what's the interesting thing? This is what is the most interesting thing to us. Why we think that the next 5 to 10 years in India are going to be very exciting and very different from what we have seen in the past. The journey from $1,000 to $2,200 per capita, which is basically the last decade or so, is going to be very different from what is going to happen from 2,200 to 5,500, which is basically doubling of the, or little over doubling of the per capita over the next decade or so. We think that there is a change happening in a lot of industries, and we have very detailed study in terms of how this change has happened in the past and what we think is going to happen in the future. But just to kind of summarize it for you, industries which go from fragmentation to consolidation leads to larger, more efficient players with higher level of profitability. Generally, industries, and this I'm saying generally, which go from consolidation to fragmentation, results in multiple new players and therefore pressure on profitability, and therefore lower margins. Where we are in that cycle, we think healthcare and pharma, at least domestic pharma and domestic healthcare, are in a multi-decade consolidation cycle, because the top 20 players control less than 40% of the pharma market, and even less so for the other healthcare aspects. And we think that the structural consolidation in healthcare and pharma will continue in India for next many years to come. The top companies already are reasonably profitable in India, and we think that they will continue to gain market share and continue to remain highly profitable. Telecom, as you all know, has gone through significant consolidation. There are now 3 players in the market, largely, which control almost 90% plus of the market. And we think that one of those players is clearly losing market share. We think that the consolidation in telecom will continue, as well as it will become significantly more profitable than it is today in the next 3 to 5 years. So, and the entry of new players in this market, like in healthcare and pharma, is extremely difficult. So you can't literally, you can't throw money and really gain significant market share in this industry. Other industry which is going through consolidation as we speak is media. As you know, there is a large merger happening and also a large investment happening in an existing company. We think that the top three media players, after this round of consolidation, will control 75-80% of the market. And to us, that is going to be very exciting, because we think that as the economy grows from $2,200 to $5,000, one of the biggest deltas that you're going to see in terms of discretionary spends is media and entertainment. And we think that the businesses are right at the cusp of where we see large growth and large opportunity. Now, airlines is very similar, has gone through significant consolidation, with now the top two players controlling, I think, my sense is close to 80% plus of market. On the other hand, there are a lot of industries which were consolidating but are now going through fragmentation because of new players entering the market. We see parts of FMCG. So you've seen a very large corporates announce their FMCG foray in the last 2 years. Existing players become far more aggressive in the FMCG space. So right from Reliance to Patanjali to Adani Wilmar, everybody has kind of announced their foray, and more, even Tata's for that matter, into the FMCG sector. Paints, similar thing, a lot of large players entering the paints industry and going through consolidation. Similarly, two-wheelers, as you would have seen, the EVs kind of come and fragment the market, and a significant new players emerging on the two-wheeler side in the EV space. And banking, and which is very interesting. I mean, I don't have a clear answer to it, but banking has gone through 20 years of consolidation, where the top 6 banks now control significant part of the new and incremental market. We don't know how it's going to play out, but our sense is new players like Jio Financial Services, maybe privatization of the public sector banks, is going to be a very interesting space to watch out for. And already banks are at peak margins. So we don't think so that what you're seeing in the last few quarters, that's kind of peak profitability with the lowest ever NPA in the cycle. So we don't know, but we think that maybe banks are at a cusp where further consolidation is going to be challenging. In fact, there is a possibility that you can see fragmentation. Next slide, please. So what we think about cognitive dissonance, so our biggest challenges as managers is when we kind of put across a narrative to an investor, there is a cognitive dissonance which happens in the minds of the investors because they have a legacy mindset. So they have a mindset where they think that, because of what has happened in the past, the narrative is very strong in their minds, and therefore sometimes it's difficult for them to kind of cognitively recognize the change which is happening in industries and cycles. So from our perspective, there is a dissonance which happens. We think that a lot of homework is needed for your mind to be convinced that the narrative can be very different from the reality on ground, and therefore the performance going forward. So I think this is something that we kind of see many a times when we kind of talk to investors about new sectors and early cycle, because they're coming from a point of view that what they've seen in the last 3, 4, 5 years, it's very, their mind is very anchored to what they've seen in the past, and therefore sometimes very challenging to kind of put across a new narrative to them. As Howard Marks always says, and we kind of a great believer that every great investment begins with a lot of discomfort. So you as an investor have to live with certain level of discomfort when you own something, in the hope that your thesis is right and eventually it plays out. Next slide, please. This is my last slide. I'm going to leave you with this thought that with Benjamin Graham, and we are great believers of this, that in the short term, the market behaves like a voting machine. In the long term, it behaves like a weighing machine. And this is really the crux of what we do. Thank you so much, everybody. I appreciate your listening to me patiently for this. I'm happy to take questions. I think I'm in time. It's half an hour. I have, I think, enough time to take Q&A, which I'm very happy to do.
Yeah, thank you. Thank you, Mr. Rushabh. So moving on to our Q&A. So let me start off with this most buzz thing, that is union budget, because that had created a lot of buzz over the town. So with the capex boost and the tax tab revisions, do you think it would stimulate positive growth in our domestic market?
Yeah, my sense is the budget was in the right direction in the sense that it continues the effort and the imperative that government has put on infrastructure, on railways, which is basically the biggest multiplier to me in the long term. The infrastructure and investment, railway investments, will be the biggest long-term multiplier for the economy. Whether it will in the next impact in the next few quarters, I don't know. But definitely over the next 3, 5, 10 years, I think it's going to be a huge kicker to the economy. So my sense is steady state, more of the same is very good. Generally lack of surprises is good for the economy.
Okay, thank you. The next big fear was Fed hike. On the same day, we had this Fed hike as well.
Yeah.
And the Fed chairman just promised us that the Fed hike is going to continue. It's not going to rest in any further soon. So do you think that is going to have a very good, great impact on the equity market? This Fed hike, which is not resting now?
Akshara, actually, honestly, that's beyond my pay grade in terms of what's going to happen globally. But all that I would like to say is that, look, higher interest rates are a reality. Whether Fed stops at the next hike or maybe a couple of more hikes, I don't know. But overall, I think we think that the rates have, and therefore the cost of capital has gone up across the world. And that is going to have some near-term impact on growth for sure. Now, whether it remains high for the next 2 quarters, 3 quarters, when it starts to change, I don't know. But clearly, we've gone through a lot of pain in the cycle, and hopefully, it should not be too deep going forward.
Okay, thank you. So I'll take one question from audience. Like Mr. Sarath wanted to know, the difference as a theme has been very narrative over multiple times. Is it still narrative, or anything changes in it fundamentally?
I think defense as a theme is here to stay because the domestic defense manufacturing and indigenization is here to stay. I don't think so that's going to change. It's only going to accelerate. However, having said that, one has to recognize that in case of defense, there is always only one buyer, largely, unless you export, which is the government of India. And that has its own set of challenges to it. Also, the fact that it's not very predictive, like a lot of other businesses, that you can't say that you're going to get an order again after 2 months or 3 months or 6 months. Yes, as a long-term theme, it still is interesting, but you as an investor will have to be cognizant of the underlying risk in this theme, in the overall context of the fact that it's not very repetitive, and also there is a single buyer most of the time.
Okay, thank you. So Mr. Pradeep wants to know, what is your CAGR since inception for this PMS?
So if you look at our CAGR since the 16 years is about 30% against 11% for the index. So that's why I said 2% alpha over that period.
Okay, thank you. So one more question from Ranjit. With infra and housing continue to boom, why do you say paint industry could see the pressure?
No, so the industry will continue to grow. See, always understand in a market like India, this is a growth market, right? If you are growing GDP at 6-7%, growth will continue. The problem is the fragmentation of the market when new large players enter the market, and therefore they will put pressure because they will try to gain market share. So generally, to protect your volumes, you might have to give up some margin or some degree of growth. So my sense is that is really the problem. So the fragmentation doesn't slow down the overall growth of the market. It might actually push the growth of the market. But you as a large player in the market might face challenges in terms of market share or in terms of margins.
Okay. So Soumya, her question is that how do you differentiate between a company at a poor cycle versus a company that actually may go bust?
Yeah, so I think that's where the skill is required, right? As an investor, that's where the work goes in. For us, from our perspective, to be able to identify companies where we think that the problem is or the issue that they're facing is temporary and there's a very large growth opportunity ahead of them. Like telecom, what they faced in terms of consolidation in the market was near term, but the growth opportunity was more long-term structural in nature. So you as an investor have to make that effort to understand whether this problem that the company is going through is temporary in nature or is it structural. And that, I think, is where a lot of our effort and research and groundwork goes into.
Okay, so other question, because the questions are popping out, there are a lot more questions out there. So
Yep.
what do you see as the bad to medium-term drivers for the media industry?
So if you look at the media industry, the pain has happened because we were going from fragmentation to consolidation. So when the industry goes through consolidation, there is always pain. But we are at the fag end of that. As I mentioned, we are seeing a large media merger go through and another company having a large infusion go through. What will drive is discretionary spend. I mean, how much time any of us now spend in front of the screen, and the screen proliferation has happened, right? Previously, if you go back 5 or 10 years, you had only one large TV screen in your home. Now everybody has access to maybe multiple screens and therefore ends up spending far more time on the screen, whether it is watching a short video or whether it's watching an IPL match or whether it is watching something else. This time which people spend on media and entertainment, and as the economy grows, people will have more spare time and therefore their spends on media and entertainment is only going to increase.
Yes, true. I think I won't get time to ask my questions because questions are going in numbers now. So followed by the next question, India market has relatively outperformed in last 2 to 3 years. We are seeing a large outflows from FII. Do you see this as a challenge? Do you believe the valuation is corrected and they will return?
See, my sense is you should not worry too much about temporary flows, FII flows. If you look back 20 years, we've seen FIIs go through inflows and outflows multiple times. But at the end of the day, we started with zero and we are at about maybe $550, $600 billion of FII money today as stock of capital. That kind of tells you the story. It's typical of the market, right? Similar to the market. The markets also go through its own ups and downs in terms of cycle. But where you were in terms of the index maybe 10 years back and where you are in terms of the index today, I think that is more important. I think the long-term structural drivers for India growth story are in place. And therefore, more and more FII investment will keep coming, barring few months or few quarters where you don't have a control because of various external measures or reasons. There might be some outflows. So my sense is the long-term structural drivers for attracting foreign capital into the country are very firmly in place, and that's not going to change.
Okay, thank you. So one more question from Nimesh is that PMS becomes crowded place now. So how do you differentiate Karma Capital from other PMS?
Good question. I think I have a question after that. Once I answer that, our portfolios are different. If you look at our portfolio positioning is different. Our largest exposure is healthcare, followed by telecom, followed by media. I don't think so any of our peers have that kind of exposure. Okay, my question is, in fact, when you see a different portfolio, does it put you off or does it make you more inquisitive to find out that, no, this might be interesting, complementary to whatever investments or equity investments that I have? So my sense is our portfolio positioning clearly differentiates us. And that's been true for us if you have go back 5 years or 10 years. Our portfolios at that time would have looked very different from the peer set or for that matter, the benchmark.
Okay, so let me ask my question also in between.
Yeah, sure.
The thing is that you're more concentrated on small caps. Being this market very volatile, So how do you manage this? How do you manage stability in your portfolio?
Very good question, Akshay. So if you look at our flagship all cap strategy today, it's 25% odd large cap and then split between mid and small cap. We have small cap exposure where we think the large cap exposure is either not available or not really suitable to what we want. So these are companies, say for example, in auto ancillaries, where there is not much large cap, though we have a large cap auto ancillary as well. Or in sectors where we think that there is very interesting growth opportunities, but there is no large cap representation available to really capture that. And even the small cap companies are leaders in the industry or very large players in the industry. So from our perspective, that industry positioning, whether it is small or large or mid, is very important. And the portfolio is reasonably balanced in terms of having a mix of large, mid, and small cap.
Okay, thank you. So one more question is that I think I'll be busy taking participants' question. Between business and valuation cycle, which is more critical to get right?
My sense is valuation.
Okay.
Again, maybe I differ here a little bit from the street. Business is very important. Let me not take away the fact that business is important. But if you overpay for a quality business, it is not going to make you money. However, if it's an ordinary business, but you have got it very cheap, there is a significant chance and opportunity that you will make money on it. However, I must say that one common denominator is quality of management. So whether it is cheap or expensive or good or bad, the business, the quality of management, if it is poor, then all bets are off. So simplistically put, I would think that yes, you might not lose a lot of money, but you will not make too much money if you overpay for a quality business.
Okay. Thank you. So Amit wants to thank you for the presentation. And his question is, what is your view on upcoming themes of semiconductor manufacturing and EV markets? Who do you list the best out of them?
I think semiconductor manufacturing is still some way away. My sense is it's too early to kind of decide where it's going to head. We don't even know who the players are till now. We have a brief idea, but I don't think so anybody has started to put any money into the ground as yet. As well as the fact that what kind of structure will emerge. It's a very capital intensive industry. Generally it's very long payback. So generally you have to look at 10, 20, 30 years in terms of how, if you are looking to put up a fab in any new country. In terms of EV, I think the two-wheeler space, as I mentioned, is seeing significant fragmentation. So typically you would want to go horizontal rather than vertical, in the sense of rather than betting on any EV player getting it right, you would better bet on somebody who supplies to all these EV players and therefore participates in the growth of multiple EV players. That's really how our view on auto anks is. But the four-wheeler space is a different ballgame, where I think again you will see new and you're already seeing new players emerge as winners versus the existing some of the existing guys. But there, I think the structure might be very different than two-wheelers. So it's going to be very evolving space. It's going to be very fluid for some time. Therefore, on the two-wheeler side, we would go horizontal. On the four-wheeler side, we are actually vertical because we think we own who is the leader today in the EV four-wheeler space. But we'll have to wait and see how it pans out.
Okay, thank you. So one participant, his name is not mentioned. He feels his thought is like very different and he's interested on your thoughts. So moving on to that, he has a question. He says that the stable fixed income options are offering 7 to 9% at this point in cycle. So is it good to increase the equity exposure?
Well, our view on equity will remain always the same, that you have to go with your asset allocation and what makes sense to you as an investor in terms of asset allocation. I would think that it is every individual's risk appetite which will determine how much equity exposure they have. And of course, you are absolutely right that the fixed income options are offering higher returns today. So therefore, clearly some degree of shift will happen in many investors' portfolio from equity to fixed income. But I think the asset allocation is really the key. I don't think so you should be too swayed by this, because at the end of the day, again, everything goes through cycle. Today they are high, tomorrow will go down. And therefore, you will have to kind of relook at it at that point of time.
Okay, thank you. So Karma Capital has been in industry for almost 2 decades, like almost 17 years.
Yeah.
So you might have seen multiple investors. So
Yeah.
how do you differentiate these new age investors and the traditional investors? How do you differentiate them in the aspect of risk appetite?
What we have seen is a significant evolution of investors in India since we started. I think the industry has become much more matured. We are seeing much greater depth in terms of the way investors look at each market participant. The sophistication of investors have improved. The tools available to investors have improved, like you guys in PMS Bazaar and now, as an investor, you are adding significant value. So my sense is that the overall industry has evolved significantly, has become far more sophisticated, and which is good for us as managers. That if we do a good job, there is now enough tools available for people to evaluate managers more scientifically, rather than really going with a hunch or saying that, oh, this guy is good or this guy is bad kind of thing.
Okay, when talking about the ideal time frame to get investor invested, so what do you think will be the ideal time frame for investor to invest?
If you're looking at any equity product, I would think you should at least look at 3 years, which is kind of a cycle that you would see generally. Maybe 5 years if you're slightly more generous, because of the kind of volatility sometimes you see in the environment, especially in an emerging market like India. So I would think that 3 years is minimum time that you should give to any equity investment you make. And maybe you should be flexible, especially if you have an event like COVID, to give a slightly more time to that.
Okay, thank you. So one question from Naveen is that IT services will increase with digital transformation worldwide. How do you see IT services faring now?
Very good question. So let me put a caveat. We have very little or no exposure to IT right now. So you have to take whatever I say with a pinch of salt. The reason why we don't have it right now is because 2 things. We think that it's highly dependent on global markets, because if US and Europe go through a recession or a cyclical downturn, IT is disproportionately impacted. Of course, digital transformation is driving IT, but still overall, it will get impacted. And if you look at the growth rates have slowed down considerably from the post-COVID highs that we saw in early 21. Also, the valuations on many of these companies are not cheap. So if you are going to see a cycle which is slowing down, then you have to get these companies at a reasonable valuation. But there are great companies in IT. I think the markets at some point will provide very interesting opportunities. So one should not take eyes off it. But today, as it stands today, we don't have much IT exposure.
Okay, thank you. Amit seems to be very obsessed with EV market. So again, he's asking us one question. Globally, most money is made in the upstream supply chain, with Tesla being an exception, which would be the best way to play the EV parts in the market. Any players have an edge in India versus globally established players, or can partner with global tier one? Sorry, I'm getting.
As they say, Tesla is more a software company than a car company. I don't think so. You have similar like-to-like comparison in India. That's why we said a horizontal play, at least from a two-wheeler perspective, makes much more sense, where you have players who are catering to multiple EV players. So it doesn't matter whether if one succeeds or the other. Overall, they will get disproportionately less impacted. So that's really what we like. On the four-wheeler side, we have the largest EV player as investment right now, where we think that again, there will be some degree of consolidation, but the leadership definitely is going to change. So the leadership in four-wheeler EV will not be the same as in the normal ICE engines.
Okay, so one more question from Arjun is that how important is ESG screening in the final investment decision?
It's very important. I think it's becoming even more important. I think the S&G part in India was evolved and evolving very rapidly, which is the governance and the social aspect. I think it's the environmental aspect which is now taking a significant precedence. So my sense is overall ESG has become very critical. And my sense is, again, it's going to keep on increasing in importance. The environmental part will evolve because still there is no regulatory requirements. It's more company to company in terms of how they look at, say, being carbon neutral or water neutral or landfill neutral. But we are very cognizant that our companies are moving in the right direction. So any portfolio company that we invest, we want to ensure that they are moving in the right direction in terms of ESG.
Okay. So one more question is that we know about the new age companies which hasn't done that great in the market. So what are the exposure that is given to in your portfolio for new age companies?
I don't know what you call new age. A lot of our existing companies have significant digital businesses, if that is your new age definition. A lot of media companies have significant digital assets, which are right now growing very rapidly. Similarly, a lot of our telecom companies have significant digital assets, which are growing very rapidly, but they sit inside our company. So you can't see it obviously as a separate investment. As to the purely digital or new age companies which are listed, my sense is they are still at the early stages of evolution in terms of the business, in terms of the governance criteria. And my sense is that this space, again, like IT, we think is very interesting. We will keep a very close eye on it. But today, from the purely digital or new age, as you call it, businesses, we don't have any in our portfolio. What we have is existing companies who have significant digital assets or digital businesses sitting within their traditional businesses.
Okay, thank you. So one question, when you talk about this final investment decision from Karma Capital, I wanted to know what drives you to the final investment decision of stock selection. The team in your PPT, you just discussed about the team, about your team. So what triggers you for the final decision of a stock?
So what triggers is finally once we have done all our work, once we are convinced that the company has a very significant growth opportunity ahead of it, we think that there's a catalyst which will drive value realization for us as investors. And we think that the management has the capability to be able to capture this growth opportunity. And we have done all our work. The analysts would present to the investment committee, and the investment committee takes the final call in terms of whether that company should be included in the portfolio. Once that decision is made, yes or no, if it is yes, then it is left. And of course, we kind of put a maximum threshold in terms of the exposure limits. Then it's portfolio manager's call to decide on the sizing, timing, etc.
Okay. So when you call your portfolio being very cyclic, so how often you cycle your portfolio?
Very good question. In fact, I had briefly mentioned it, but maybe I can use this as an opportunity to explain it. So we are really long-term investors. Our average holding period is 5 years for any company we buy. Our churns are very low, less than 30% in our portfolio. So once we buy into a name, typically it remains with us for 5 years. We add maybe 3 or 4 maximum names a year and remove 3 or 4 names. So our change actually is very slow. And this is the reason why it is because if we buy early cycle, then we can own these companies for a length of time. And we have a company now that we have owned for 9 years, and the company has become a 10 bagger for us in the 9 years. So it kind of gives you an idea that if we are right on our early cycle call, we can own these companies for a length of time, and therefore it allows us to take and the reason why we are in that business is because you would have bought it at a very reasonable price.
Okay, thank you. Due to time constraint, I want to end up with one last question. So,
Sure.
India moving towards $5 trillion. So, what is your opinion on what are the headwinds India might face while in its path?
Well, I think my sense is general, whatever that you hear, I can't add anything more. Geopolitics, we kind of, our internal politics. Otherwise, if you look at the economy, it's in maybe the best shape that it has been in many decades. So if you look at balance sheets, and balance sheets drive growth, P&L don't drive growth. If you look at government balance sheet, if you look at corporate balance sheets, if you look at bank balance sheets, and if you look at individual balance sheets, you don't see too much leverage. Which is the first time in many decades that we are in a position today where we have a government revenue which is increasing very rapidly because of GST and other steps which the government has taken. Corporate sector, which is at a maybe lowest point of leverage that we've seen in the last 2 decades. Bank balance sheets, which are very clean, which can drive the growth, and individual balance sheets, which are not very levered. So higher interest rates will cause you some near-term pain. But I think as a country, we are well positioned to kind of grow significantly faster than we have done in the past.
Okay, thank you. So with this, we have come to the end of the session. I must thank you for hosting such a great webinar, and also Pramod for answering the questions, because there are a few questions which are still unanswered. I might take the questions and please take some time to answer them and revert it back. So
absolutely.
Thank
you, Aksha, and thank you, PMS Bazaar, for having us. Thank you, everybody, for patiently listening to me. And we'll come back to you with whatever questions you have in terms of answers.